Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Learning from Financial Fraud series on the Treasury Update podcast. In this series, we will explore multiple major financial frauds and thefts to see how each one occurred and was kept hidden for a period of time. And we'll dissect how it was eventually discovered and get insight and guidance on how to prevent this type of situation from happening in other companies or your company. I'm Jason Campbell, the host of this episode, and I'm joined with Craig Jeffery, managing partner and founder of Strategic Treasurer. So let's begin with this first episode in the series and talk a little bit about the Parmalat fraud. Now, the Parmalat was an Italian dairy and food company that experienced a pretty significant fraud case that kind of led down to their bankruptcy back in 2003. And so, Craig, welcome to the show. Looking forward to hearing about this in this particular episode. And let's kind of kick it off by going into exactly, can you detail us out what was the situation with Parmalat?
Well, I'm pretty excited about this series. I think there's so much that can be learned by financial frauds that have occurred, and they give us real life examples of how fraud has gotten past some of the controls that existed there. But to your core question about what's the situation with Parmalat, what happened back then, in 1999, everything started getting discovered and they ended up filing for bankruptcy in 2003. So this is a long time ago, but this is definitely one of the largest corporate frauds in history, massive on a scale for Italy. The situation was all kinds of financial misstatements, creating fictitious transactions, creating fictitious balances in accounts, really significant. Overall, the total loss was around 14 billion euros. One of the losses was related to a $4 billion US dollar overstatement on a bank account, and they falsified audit records. And that's a really interesting story about how they did that. But this was a real significant situation. When auditors are checking, they're checking to make sure you have the assets. The assets are, physical assets, or they're cash in bank accounts. The $4 billion was not in the accounts that they had talked about, but they were able to get a fictitious certification on those accounts. How that worked is they created and said in the books of the organization that they had about $4 billion US in the account. The auditors prepare the statements and documents that they're going to send to the bank for validation. What happened was the Parmalat people that were working with them said, we can have our assistant mail those out for you so you don't have to go post it. And they somehow took them up on that offer, which is surprising to me, right? You have to have a separate and independent method of handling that. Well, they took those verification letters and they verified them themselves and sent it back so that the auditors received confirmation that they had $4 billion US that didn't exist. And so falsifying records and then falsifying the records used to validate or verify those balances, what happened. So it's really pretty amazing how they did this. And it wasn't that they did it only by setting up an account. They created a huge network of different subsidiaries, organizations, created in the books of the organization fictitious transactions. They had and showed different types of revenue streams that would give rise to the assets they had. They also, issued bonds to support everything that went on. So it looked like it was a very active, well-performing business. But this was a significant challenge. And there's a couple of those core issues. You said, what's the situation? Well, there were a lack of a number of controls, both inside the company, and there was collusion within the company, and then there was lack of good controls on the outside of the organization as well.
I mean, we're talking about 4 years in the making, right, of things that were going on. But I don't know about anybody else, but I'm thinking about $4 billion, right? $4 billion USD dollars. That's just a lot of money that just to not have a grip on or a full understanding. And from a standpoint of the reporting and the lack of control in this situation, obviously the end result was devastating to that company. But just knowing that, how somebody for 4 years was able to kind of have this mastermind of how this process was working out to defraud the company, which is absolutely insane.
Yeah. So to that, what were some of the things that triggered It's discovery. Well, in December of 2003, they weren't able to make bond interest payments. So they were able to create these fictitious transactions, subsidiaries, create this great level of complexity and generate what looked like significant assets. And so they could raise funds. They were also borrowing funds. And so everything worked well until it didn't. They were no longer able to pay for those bond interest payments. Well, when you think about that, you're just paying interest. You're not paying the debt back. And so that triggered significant suspicion, because if this organization is doing so great, how can they not pay the interest? And so the whole house of cards fell apart. It wasn't like they were bumping along. They were doing fantastic, or so it looked. And that triggered all kinds of research in the media by investors and different creditors. And then through that process too, the Grant Thornton discovered there's some discrepancies on what's going on to accounts. It doesn't match what's in the book. What's on the bank doesn't match in the book. And this is where they eventually unraveled the whole scheme. But that issue of falsifying, confirming statements from the auditors certainly bought them more time, because that would have discovered, hey, there's $4 billion missing here. And they were able to delay that.
Well, just going off from a delaying perspective, now obviously, the discovery to this and having, that importance of having an outside independent partner coming in and being able to really go through the books to find those discrepancies, to kind of, it's like they say, if there's smoke, there's fire, right? And so to really trying to find out the specifics on what's going on and being able to have that discovery, I'm sure, obviously the investors would have loved to have had it earlier, sooner rather than later. But, obviously the timing wasn't exactly ideal, but at least, getting to knowing what's going on as they were missing those bond interest payments. So talking about now that we have what led to discovery, I guess the big thing is, what was the result? We have the discovery now. What happened because of that?
Well, there were arrests. There was the filing of bankruptcy by the company. I think it was tens of thousands. I'm not sure the exact number, but tens of thousands of employees lost their jobs. And then there was a lot of losses on the investor side. In addition, there was additional concerns. I mean, anytime a significant event happens, people are like, what's going on with this particular country? Whether in this case it's Italy or the U.S. or Germany, there's concerns. So there's a loss of confidence in how is everybody being governed in these particular countries? Why wouldn't the controls catch it? So those are some of the most significant items.
So when we think about I guess now for those who are listening and thinking about, I don't think that can happen to me, right? Anything is possible, right? Anything from a standpoint of we talk about criminal masterminds as the sophistication, the technologies, the way that data is transferred. I mean, there's a lot of potential vulnerabilities and a lot of systems, companies, organizations of not having the proper controls in place. So kind of let's talk about, now that we've kind of exposed this particular fraud case and the magnitude of it, what are some ways that this type of fraud could have been, or maybe and potentially just to prevent it from occurring in somebody's organization?
Yeah. So in this case, there's quite a bit that we talked about. I'll limit it to three. So first is, your independent auditors, your external independent auditors need to be truly independent. They shouldn't rely on someone else to mail out confirmations. That's certainly is very obvious just from our discussion. So that's the free one. The second one is, organizations should have a systematic internal audit of accounts. Whether this is done by the internal audit department or even a third party on behalf of Treasury, for example, this systematic audit of accounts. Where are accounts? What are balances in those? Validation of who can sign. That type of activity is essential. And I think it should be pretty standard for organizations above a certain size, let's say above $1 billion or $2 billion in annual turnover. Third, when we think about full daily visibility to cash on a global scale, this is the standard of good corporate conduct. This is commercially reasonable. You should be able to see all of your cash every day on a global basis. If you have accounts, your cost of doing business is having access to that. That should all be reported on a daily basis, not reported by paper statements that roll in on the 10th or 15th that may get entered in an accounting system way late that could be easily forged. This should be digital, daily visibility on a global scale. This eliminates blind spots, and that certainly would point out not even the 14 billion euros or even the 4 billion US dollars in that one account. It would show and detect that much, much sooner. And then at a proportional level with other organizations. So this helps eliminate blind spots. Jason, many organizations have what they call like a cash report, a flash cash report. They come up with some creative name that shows where is our cash globally? What banks, what entities, what currencies? How is that changing over time? That provides a real focused view of what's happening on the cash basis. Now, there's always this challenge of we don't want everybody in the organization to know everything that's going on. You certainly don't want everyone in the organization to know the profit or loss or what's occurring throughout the month, right, to get that type of information. So there's an aspect of limiting what's known of financial information. But certainly it shouldn't be limited to just a few people on knowing where all the cash is. That should be, Treasury Group should know that. That should be known to the senior executives. So if you were to try to do collusion, it would have to be to a massive number of people to say, here's where our cash is. Why is it changing so dramatically? Did we just issue, $10 billion worth of bonds that we have a influx from? Why is it changing over time? So full daily visibility, systematic internal review and validation of accounts, and then truly independent third-party audits.
As you were talking about these pieces, it goes back to, it's trust but verify, right? And having those control things in place. As you said, the multiple layers, whether it's multiple signers or whether it's, multiple folks who have access to the visibility. It shouldn't be a secret from a simple fact of locked in a vault by one person that's held to, that one key is held to their heart. It should, there should be some place, some controls in place or processes in place to ensure that there's a grip on, the cash flow. As I always thought about in my time, in my career, I always looked at from a standpoint of somebody who has some ill intent to cause a fraud or theft, right? It's usually because they try a little, because they're wanting to see how well you're on top of things. What are your processes? Where's the vulnerabilities? Is it the actual human vulnerability, or is it a system or process vulnerability? And I always think about that thief may start off by taking the dollar, right? $1 to see if any alarms are going to be triggered, any noise is going to be had. And then that next go around, it's a $5, it's a 10, and then it's the big one, right? Then it's $4 billion because they realize that, they're able to infiltrate and penetrate and not have the alarm go off. And I think sometimes we kind of trust too much and not verify enough, to make sure that what we have is safe and sound to prevent, your organization from, not being the next Parmalat, and making sure that, you're not losing $4 billion out to somebody.
Yeah. So the 4 billion US dollars can lead to 14 billion euros equivalent across the entire organization. So it certainly scales. And, the trust but verify, the Reagan, quote, trust but verify, the see and verify is what we're talking about here. You need to be able to see it, see where your cash is, currency, bank, et cetera. And then that should be able to be verified both by Treasury as well as by independent areas. So those are all appropriate warnings to people.
Absolutely. Well, Greg, thanks so much for the discussion today, and hopefully our audience took some of this to heart, especially as this real case study of Parmalat and the situation, their fraud case, and kind of how it happened and what the consequences that occurred after that. For our listeners, thank you so much for joining us today on this series of talking about learnings from financial fraud. Hopefully you enjoyed this episode here, and then look forward to having you on our next episode as we discuss another fraud case. Until next time, take care.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.